Today is May 28th, 10:30 a.m. CET and 4:30 p.m. Manila time. This episode, we talk about Chinese property firms buying into chip makers to revive valuations, Italy's slow progress on reforms, US and European central bankers signaling openness to rate hikes, and the new normal for the global economy post-war. Hello to our listeners. I'm Mel Lopez, Chief Economist for ASEAN.
And I'm Peter Lundgren, the founding CEO of Lundgren's Capital.
This is Sound Economies with Mel and Peter, a weekly East meets West podcast by Lundgren's Investor Insights. Join us as we analyze developments in major economies and financial markets globally. Hello, Peter, and hello to our audience. How are you today, Peter? What have you been up to this week?
I'm fine, Mel. Thank you. Excellent today as well. It's the summer has finally come to Denmark. It's
Wow.
very nice sunshine. We know that it is somewhat more hot if we're going southwards in Europe, but here in Denmark it's actually just very nice. But honestly, we are in the office from early morning to late evening. We have a lot to do, and actually also quite a few things happens in our defense fund. Let's see if there will be something to mention the coming weeks. But interesting initiatives for this. Yeah, so it's all good. Yeah, Mel, how are you doing?
Well, it's also very, very sunny here in Manila where it's almost sweltering. But of course, uh, we had to work every day and get ourselves busy with whatever's happening in financial markets. We are working on our next publication, so that's really on the top of the list right now. It's coming out in a few weeks, so that's something to look forward to for our subscribers. Yeah, so that's available on the Lundin's Investor Insights app and website very soon. Actually, it will be about the China and ASEAN region. And I can get started with our episode today with China. A very unique way, I guess, to work with the one of the biggest issues that's been hounding the economy for so long. We know, and we've talked about this in articles and past episodes of the podcast, that it's the real estate sector that's struggling in China. So initially, they wanted to regulate the health and the debt levels of these property developers, which eventually led to uh, chaos and some bankruptcies here and there. So now these property developers have found a unique way to revive their valuations like 5, 6 years after that crash in the market. Their workaround to falling valuations now is actually a quick fix. So they're investing into chip makers or semiconductor companies in China just so they could ride on the AI hype and hopefully bring up their share price in the process. Around 10 or so unprofitable real estate companies have done this strategy so far. And of course, the regulators are quick to catch on, and I would not be surprised if additional regulations will be put out just to rein these practice or these companies back into their lane, because I get diversification. We understand that, but it's not their organic business and it's not their main function. They're not holding firms. They are real estate developers. One case that was already initially put under investigation by the regulators in China is a company called Metroland. So they're in
Mm.
Beijing, and since they began doing this, they got pulled up with the AI effect. Their stock is now up 314% versus last year. When they started when they bought into a chip maker company, so they got a 20% stake in there last week. And that's when the share price really shot up. And of course, uh, regulators took notice and they were told to disclose more details about that transaction, their financial health, because apparently they are in the red for so long, ever since the property market crisis in China. So yeah, it's so questionable, and we don't want to see this kind of like play or deception that you're a property company, but you're profitable, or your main allure is to offer some into a semiconductor company. It does not change the weak home sales market that you're mainly into. At its core, it's still very much down. So investments like this jazz up the share price for now, but it's not gonna be sustainable, and it's only a short-term gain. You're not sure if any dividends will actually go into helping the property sector go back up. And that's not the kind of exposure that you want if you really do want to get into the tech and AI space in China. So
Yeah,
I'm
yeah.
I am wary about this situation. I don't think it would last long. I'm sure Chinese regulators won't let it go, and that would probably spell more intervention that we would like to see.
It's it's another amazing story out of China. This is it's actually not the first time we see this kind of
Mm-hmm.
or how should we say actions or whatever. But it is, of course, a warning to the investors out there who are wondering why a property developer all of a sudden is going sky high. Yeah. For those who really want to go into property development, they need to watch out. Yeah.
Mm-hmm.
But it is an interesting story, as I mentioned seen before. But as you say, okay, it can be that the authorities they need to either comment or intervene or whatever. So that is also worth to keep an eye on. This is China. A lot of things goes on. If you talk about as you say, the housing market,
Mm-hmm.
and so it's a serious issue, and this is important.
Yeah.
Anyway, so we subtract a bit if there should be some positive news out of the Chinese housing market. We would recommend to study very carefully what
Yes.
goes on.
Right.
Good.
Peter, let's head over to your side of the world. Just to switch things up, we've been talking about Southeast Asia and Asia recently, so let's take a look at Europe more closely today.
Yeah, let's return to one of the more stable areas in terms of growth, very close to zero, and no movement. So it's amazing, yeah. But the reason why we bring Italy forward today is
Mm-hmm.
actually to take off in a very very good article Financial Times had brought for a couple of days ago. Well written, well researched, and having a focus in Italy, you could say, is that fair? Now, the reason why the focus on Italy is the case is we go back to the COVID-19 period where EU decided to approve the biggest economic rescue package ever, and that was really by far ever. At that time, we again argued against it,
Yeah.
and that is not because we argue against helping
Mm-hmm.
countries or families or companies or whatever who are in the need, but it is just arguing against pouring taxpayers' monies into to sort of public spending that on the surface is said to, at that time, go back and see the headlines and explanations. It should actually change the Italian economy. It should not only recover the economy, it should actually be sort of milestone setting initiatives. Most of the money have been spent and nothing has changed. What only happens is it leaves an enormous mountain of debt, so to say. And this is the key, and this is we have mentioned it several times, and this is just another good reminder that we are afraid of every time we see a challenge in the old economies, and we actually also see it a bit in the US. The
Yes.
reply is just to increase government debt, and it is so obvious that the political leadership they just hope they simply reshuffle money into the economy and hope it will kickstart, and
Yeah.
then we have solved the problem. But this is what not happens. This is simply what happens. Um, so there we are again, and it is also a bit. It's not just a complaint. It is also sort of but it is actually also a bit a reminder because we are looking into to sort of the mega trends in the world, and that we will revert to in just a few minutes. Yeah.
Yes.
So that is also why we have this issue with, as an example, Italy. Italy has done some, how should we put it, okay things in terms of a bit of labor market reforms, and then they are joining the sort of the global competition about attracting wealth family, wealth
Yes.
households, wealth people by offering a flat tax of 250,000 euro.
Mm-hmm.
And now that sounds like a lot, yeah. But there are people out there earning a lot of money where a flat tax of 250,000 euro is a bargain. So they are doing some different initiatives, but they're still smallish. If we compare to uh, basically a neighbor country on the other side of the Croatian and sea, Greece, that
Yes.
is our current favorite within the EU, hiking work weeks to 44 hours per week, and people are working 6 days a week, a week, depending on which sort of position they have. They might also work less, and
Mm-hmm.
they're not forced to do so much. But this is when we talk reforms, yeah. And Italy have taken very small steps in that direction, but not enough by far, not enough to sort of make it fueling any uh, healthy changes in the economy. So now we just have another reminder of a debt mountain that they created without any sort of big effect. So this is we have raised a concern as mentioned, and it is a concern from our side. Debt, government debt in the old economies. Is that the reason why interest rates are going up, or is it just because inflation has been pressuring higher? We would argue it's both, but actually the concern government debt is a major reason for for the increasing interest rates in the long end, 10 years. But, well, something might also happen in the short end.
I do remember, Peter, that a few magazines ago, we gave Italy, like, good words. We had good words for
Yeah,
what they were doing or with what they were trying to do with the reform money and with the Draghi report. But it's looking like it hasn't really materialized into anything substantial as far as lifting the growth potential. And that's what we're worried about.
yeah, exactly. They need to do more. They were a bit on the right track to do some, to come up with some praise.
Well, let's hope that they continue that way.
Yeah,
But at the same time, we also acknowledge that it's harder to get things done now, perhaps, because after COVID, because that was a COVID grant, now comes this period of elevated inflation yet again, this
yeah,
time due to energy prices. We have been talking about it repeatedly, all because simply because it's really starting to hurt economies a lot more because it's growing more persistent. Elevated inflation has persisted in the past few months already. And we are hearing from central bankers, particularly from the US Fed, and we also have someone from the ECB speaking up about high inflation persisting and how they're seeing it as a bigger problem than initially anticipated. And of course, this ultimately leads to the discussion of will there be rate hikes coming in June? So from
yeah,
the Fed, we already have three different governors speaking up publicly about it. So we have Lisa Cook. So we remember her from the Trump case that did not prosper. She did say that the base case is that inflation will head down in the next few months, maybe later this year, not immediately. So that's actually what we see in the horizon as well. But she did say that she's prepared or the Fed is prepared to raise rates if inflation goes on well above target, which has been above 2% in the last few years. Then we also
mm,
have her colleague saying that Governor Kashkari is saying he now looks at inflation as the bigger problem than the unemployment rate. A year ago, the discussion was the reverse. Um,
yeah,
and that could also win a rate hike vote if he sees that inflation is becoming unanchored, especially the inflation expectations. And then there's another colleague saying that inflation is not as temporary as Trump or as their advisors initially advertised to be, and that
mm,
it could be another reason to do a rate hike, maybe as early as June. The tricky thing about it is the next policy meeting would be chaired by Kevin Warsh. So he has just been appointed by Trump and sworn in. He takes over Powell as Fed chairman. And of course, we all know that he was put in that place specifically to cut rates. But
yeah,
ironically, they can't do that because of a problem that Trump also created for the world. So that is
yeah,
a very difficult position. And we also see an ECP governor for for the Bank of France saying that they need to act if second round effects are already like here or very very close to spreading across all other goods that's widely used by consumers. So there's
exactly.
really a higher for longer inflation scenario is starting this whole conversation about rate hikes becoming more and more imminent. Um, but the bigger consequence of that is, of course, you'd kill off further growth. Well, in the case of Europe, that would be closer to zero again, or even in the negative territory. So it's something that we really are watching closely
Mm,
because between now and the next few weeks, we don't know what the situation will be. Some days it's sounding like a truce or like a deal will be achieved at the Strait of Hormuz, and then
mm,
just earlier today, actually, there was news that there was an attack again in the area in the Middle East that a ship was I think hit by a missile or a attack ship. So
mm.
that the situation is very hard to predict, and which is also explains why the monetary policymakers are trying to like cover their bases with to
Mm.
maybe to justify ahead that, oh, if we do a hike, this is because of this, and then if we hold, this is also why. So they're very tentative as well.
Yeah, sure they are. With good reason. They are talking to us. So they're communicating with the market. It's not just a coincidence that we have these quite a few central bankers officially talking about the risk of a rate hike, yeah, as it can be needed. Our position is we fully recognize the risk, and we also listen to what the central bankers are sort of mentioning.
Mhm.
Um, we as long as the inflation is higher due to higher energy prices, we keep the position that the energy price will come lower one day and they'll settle. And as long as that's the case, there will be no rate hike from the central bankers part. But if, and you also mentioned, if the second round effects start to be mm, more than just visible, as a really we can really see them, then they will
Mhm.
be forced to hike rates because they cannot allow themselves to be behind on the inflation. That is the most dangerous thing that can happen for an economy. So they'll be forced to hike rates as on the short end. And then we have the good question. Will that only be in the short end? Has the long end, the 10-year yield, have investors already included a rate hike or higher or more consistent higher inflation in the current prices? Maybe we don't really know. There's a rate as a rate hike today would certainly cause that the whole curve will move up a parallel and also lead to higher long-term rates. But it's not today. We will have the rate hike, as you say. Is the discussion in June or not? We're not so sure. But that is the trigger is if the second round effects sort of to start to bite, then we will then they'll need to act. Second question is the equity market, are investors ready for this? In the fixed income market, we have seen the raising interest rates, and part is due to inflation fear.
Yes.
Another part is the rising debt. It is simply getting more unsecure to purchase government debt in the earlier so strong nations like Germany, France, Italy, even US. But that is, it is also, there's, we would argue there is inflation fear built in, partially. But a rate hike today would be a surprise and that would lift everything. What about the stock market? The stock market is not prepared for a rate hike yet.
Yes.
That's that's how we see it. It will be seen negatively. On the other side, so the leading indices around the world are dominated by tech companies, and they will suffer a bit short term, but they'll come back. So on the surface, on the big indices, it might not look a lot, but there will be sub indices, more national focused indices, or mid cap indices. They will suffer a bit more on
Mhm.
the rate. Is it enough to reduce the overall stock positioning as a positioning to equity market? We would say no, but
Yeah.
it could be a reason if the signs are increasing for a rate hike to reposition apart. And a rate hike will be due to inflation, and inflation will hurt the household economies. So companies as a equities, stocks linked to household economies is where we see the biggest danger.
Yes.
Sort of in the stock market if rate hikes starts to become all of a sudden very modern, so to say.
Yeah.
So right now we're not there, but this is something we certainly keep an eye on, and we are pretty defined about what we think will happen, and that is every day, every minute about how we judge the
Mm-hmm.
probability of this to happen, and that can change at any time. Good. Yeah. So this is a bit going on. What's going on there? Not what people in general would say. Okay, it's it's sort of welcome and optimistic. No, this is what we're facing, and we need to cover it, of course. And we this is also the conversations we have with investors. Where we are.
Of
Good.
course, Peter, a lot of the energy price and inflation discussion, and of course the interest rates, it all uh, goes back to the US Iran situation. Um, there has been optimism until like up to yesterday that a deal will soon be reached. And then when we woke up to Thursday, there's now like more uncertainty about the progress in those talks. We'd like to revisit this. Yeah, we talked about the mega trend earlier.
Mm,
Initially it was just the Russia-Ukraine situation that has disrupted global flows, and then now is the US-Iran conflict that's been relatively like shorter, but of course the impact is what much wider. When, not if, the situation or a deal has been reached and the strait has been reopened,
mm.
how would the world, how would the US economy, how would the Europe markets look like in that development?
So we are increasingly spending time on on the mega trends, as maybe also our listeners has noticed the past episodes. There have been a period where we could say a lot of noise, a lot of Trump generated chaos, and we've had also the invasion attack war against Ukraine, and lately then the U.S. Iran conflict in the Middle East, creating a lot of movements, a lot of noise, a lot of short term things to consider. Maybe the world settled a bit, so to
Mm-hmm.
say, that all of a sudden US and Iran they might reach some sort of a deal or ceasefire or whatever. The same could happen in between Russia and Ukraine. We should not forget that after the visit, US as a President Trump visit in Beijing lately, there's been very quiet. And not a lot
Yeah.
came out from the meetings. There can be several reasons for that. Maybe they didn't agree on a lot, and that is actually all the topics were misjudged. Uh,
Yeah.
Trump, he came with all his tech guys. Why? As they're not really, the Chinese will not really be impressed by these people. But there might also be another reason why they have been quiet. There could be a very good chance that China is working a bit on behind the scenes also towards Russia.
Mm-hmm.
China has no interest in the war. China has big interest in global trade, as a peace and global trade, and then they can dominate their own area, the region, politically. This is how they want the world to work. All of a sudden, there could be the situation where we see U.S. Iran is escalating.
Mm-hmm.
There might be a ceasefire in Ukraine, between Ukraine and Russia, and the leftover is then Trump running around and doing noise. But people have sort of, luckily wise, got used to it and are not making notice of all the tweets and shouting as they did for some time ago. So if that happens, so how does the world actually look like? How is the world after this, let's call it settling a bit down, yeah? And this is what we spend a bit time on, more time, saying, okay, what is the long-term prospects? And this is, it's where we circle back to, again, also topics from earlier podcasts saying the countries that will move forward are the countries that are flexible in the economy, that are not too debt loaded. There will still be some financial maneuver room,
Mm-hmm.
uh, and there will be high domestic demand consumption. And that is actually why we still like the Philippine economy so much,
Yeah.
because it fits in, yeah. These are the economies that also flexible labor market, long working hours. So it means there's a good chance for more
Productivity.
efficiency and productivity. The cookie is simply bigger, yeah. So these will be sort of the economy socials.
Mm-hmm.
And if we look into sort of the discussions domestically within these economies, it's when I observe it, it's very different to what is going on in the old economies. The old economies, there's headlines every day, sort of almost on their branding, saying the world is chaotic, the world is breaking apart, the world is changing extremely. This is not what we see in emerging market countries where that stay flexible and are healthy.
Mm-hmm.
There we more see, okay, there's some headwind right now, higher oil prices. That's painful. But it is much more about focusing on opportunities still. The world is also changing for the emerging market economies just as much as it's changing for the old economies, but it
Mm-hmm.
is seen as an opportunity, and in the old economies, it's seen as a threat. This is what we will see intensified if the world settles down. As a Iran, US settles down, there might be again ceasefire, Ukraine, Russia, whatever, where we will say, okay, we would actually normally say now we can start to move forward again. But we will see this split. We reckon we will continue to see the uphill feeling in the zero growth economies, and we will see faster growth again ahead for the flexible economies.
Mm-hmm.
This will be more outspoken in this what we actually think as maybe a soon coming new situation. And this is one of the mega trends that we are sort of looking more into as well. Um, Trying to see the world is will start to move forward in another way now
Yes.
for those economies who can. And if that is the case, this is extremely important for investors to be rightly positioned there. It's a bit
Mm-hmm.
more long term, okay? But extremely important. So this is, after all, in 2 seconds, we'll talk about the sunshine and clouds. But this is actually a sort of sunshine, yeah.
Yes.
So yeah, this is another mega trend we are trying to dive more into,
Mm-hmm.
and we will also revert to it for sure.
To tie it back to our discussions from a while back about the middle class, the global middle class, that will only accelerate the rise of more middle class individuals in developing economies and the decline from the higher income levels to
Yeah,
the middle income levels for
Yeah,
those in the mature economy. So that's really, they're meeting in the middle, some for the better and some for the worse. And
yes,
yeah.
the global middle.
Peter, let's dive into the global outlook as we always do. Of course, we think that the energy inflation scenario is taking front and center of the discussions, but we see that some economies are better equipped to navigate this fuel, high energy price situation better than the rest. Of course, as far as sunshine, we do see more rays of sunshine in the developing economies, particularly in Southeast Asia and China. Um, Inflation is starting to be pick up faster here as well as in the West, but the flexibility is much more pronounced as far as fiscal space is concerned for this developing economies, and households are more equipped to smoothen out their spending despite the higher prices. And we can't really say the same for the old economies.
No, exactly. So can we convert that into to sunshine? Yeah, we can. As we reckon, as we talked about, it's a bit cloudy world with the risk of more hikes from the central banks, whatever. Yeah. But as we say, we also see the upside in the flexible economy, and that is actually sort of the our main key picture. Emerging markets are doing and will do good again. Uh, the the hikes, the risks of higher interest rates is not enough to for us to downscale the allocation to stocks.
Yes.
But we do see, this is a reason why we like to be in the non-listed market. It's actually more attractive in many ways. Yeah. So the allocation there fits well into if there should be a bit more just volatility in the listed market. And then there could be some adjustments within the stock portfolio that will reflect that particular old economy households will just get more headwind and
Mm-hmm.
not less headwind if we look forward the next 6 to 9 months. So this is sort of how we see it, but we do see predominantly upsides in the world, and that is why we say there is more sunshine.
That's all we have for today. Thank you, Peter, and thank you to our listeners. We'll be back next week.
Yeah, thank you so much.
Thank you for tuning in. As always, we keep a watchful eye on market shakers and movers. Catch the next episode of Sound Economies with Mel and Peter, a podcast by Longines Investor Insights. Available on Spotify, YouTube, and wherever you listen to podcasts. Longines Capital has been in the business of investment advisory and wealth management for over a decade, with our high-performing and multi-awarded funds to show for it. We're taking this to the next level through an IPO in 2 years. Join us in this journey. Visit our website to learn more.